everybody. This is Rob Keynes with the Freedom Report. We are back on a Tuesday, May 21st, 2024, with your weekly market report. A little bit of talk about regarding data and what's going on in the economy. Then we're going to switch over to the general markets, maybe discuss a story or two. We're going to talk about quiet quitting and how that's affecting capacity utilization and the ability of the economy to produce, particularly with the millennials. And then we're going to go right into gold and silver. And when I focused last week on gold, long and short-term charting, I'm going to focus more on silver. I'm going to also show you where that price is trading in silver and how much is being delivered. Continuation of the trend I've been talking about recently, but I have a little bit new data on that. So we're going to dive right into it. So looking at the economic calendar, I think we already reported last week that the producer price index went up more than expected, which means coming inflation to consumers. It's the wholesale price index. In addition to that, CPI came out, core PPI, which is a government measure, was also up. So it looks like wholesale prices are up no matter what measure we're looking at. Later on in the week, after we talked about that report on Tuesday, last Wednesday, the consumer price index came out. It was holding basically steady at the moment at 3.4%. It was 3.5% increase the last month. So that's overall about the same, but with those increasing wholesale prices, eventually in the next month or two will work its way into consumer prices. U.S. retail sales are down. They're flatline. Basically, they have not increased month over month or year over year. And overall just signals and continuing weakness in the retail sector, no growth there, which probably is going to lead to a lower GDP reading at the end of this quarter. I would expect, but consumers are a huge part of the economy. So GDP, you can expect to continue to trend down in the next quarterly report. The Empire State Manufacturing Survey up in the Northeast is down 15.6. It's cratering. It was down 14.3 last month. It continues to crater. There's only been 1 or 2 positive months in the last 7 or 8. And so manufacturing really in that part of the country has completely fallen off. We're also seeing business inventory shrink, negative 0.1%. So shrinkage in the economy for businesses. Businesses don't need as much. Why? Because people are using less services and buying less things. So overall, just contraction around different areas of the economy. Home builder confidence index, after soaring at the beginning of the first quarter, has now come back to reality. It's down to a 45 reading, which is a negative reading, or not expecting growth, down from 51, which was slightly positive, or slightly into growth expectations for last month. So we can start to see as well that the real estate industry starting to trend down as home builders do a little bit less building. Now, housing starts did rise slightly from 1.29 million to 1.36 million, but the permits have fallen off from 1.49 to 1.44. So people may still be looking for some new build, although overall in the existing build and existing sales are starting to fall off, and that's the bigger part of the market. And I think that people are looking for new build to get those new amenities and features, while a lot of people with existing homes don't necessarily want to sell them unless they're just getting out of the housing game and maybe going to an apartment or alternative living arrangements. They're certainly not selling their cheaper mortgages to get into a more expensive one. So I expect that the new housing starts and building permits is going to start to fall, as well as we run out basically of buyers. And I think that's why the home builders index is going down, because they see what's coming. They see the data and they see what's coming. Industrial production was flatline, no increase whatsoever, again, leading to what I think is going to be a weak GDP report at the end of the quarter. Capacity utilization is sitting at 78.4%. What does that mean? It's the ability of the economy to produce. We've got, in other words, 22.6% of slack in the economy. When you have slack in the economy and a failing retail sector and businesses starting to pull back and lay off, it basically means not only are you not having jobs and growth, but you're at less capacity. And so I expect that means that we'll have more job losses and lower GDP going into the future, because we're not even producing at the capacity that we're paying people for, which means labor costs probably have to come down and more layoffs are coming, basically is what I expect. There's a really interesting story on CNBC about millennials. And the quote of this article is, "Millennials are quiet vacationing rather than asking their boss for PTO. There's a giant workaround culture." Now think about that for a minute. There's a lot of pressure on job holders to keep their jobs because of layoffs and things like that. There's a lot of pressure to increase productivity because of that capacity utilization rate I was talking about, but it's not really happening. Millennials, I think, looking at their prospects for growth and additional income, are saying, well, we're just going to, it's not quiet quitting. It's more of like quiet vacationing. They want to keep their jobs. They want to look busy. They don't want to take PTO because they're afraid of making them a target for a layoff or a job loss or something along those lines, or maybe not getting that raise. And so they're doing it in the background. Of course, remote culture has enabled this a little bit. So companies are trying to pull people back into the workplace. I still think there are ways to do quiet quitting and quiet vacationing in the workplace by doing other things, not being productive at work, but it's a lot easier when you're at home. And I think that's why a lot of companies are trying to pull workers back in to see who's being productive and who they should keep. A quote from the article written by Maria Korneva. Oh, I'm sorry, this is written by Jennifer Liu. Quote, paid days off from work aren't a guarantee for many Americans, but even when they do get them, they're leaving them on the table. A majority, or 78%, of U.S. workers say they don't take all of their PTO days. And it's highest among Gen Z workers and millennials, according to a new Harris Poll survey of 1,170 American workers. Younger professionals say they don't ask for time off because they feel pressure to meet deadlines and to be productive. And they get nervous requesting PTO because they don't want to look like a slacker, says Libby Rodney, Chief Strategy Officer at the Harris Poll. That's not to say they're not taking breaks, they're just not telling their boss. Millennials in particular have found workarounds to play hooky. Nearly 4 in 10 say they've taken time off without communicating it to their manager. Similar shares say they move their mouths to show they're still active on their company's messaging platforms when they're not really working, and they've scheduled a message to send outside of regular hours to give the impression they're working overtime. There's a giant workaround culture at play, Rodney says. While Gen Zers tend to be more vocal about workplaces that shame people for wanting to ask off work, millennials would rather take matters in their own hands, but under the radar, not become targets, not put the target on their back for potential layoff because they see what's going on in the economy. Quote, they will figure out how to get appropriate work-life balance, but it's happening behind the scenes, Rodney adds. It's not exactly quiet quitting, but more like quiet vacationing. That's going to continue to push down the productive capacity of the economy. It's hard for employers and economists to see that directly. It's kind of behind the scenes in some of the capacity utilization type numbers, which aren't the biggest quoted ones, but you can see in some of the statistics with less production, less utilization, falling GDP, that this is sort of what's going on. It's not just millennials and Gen Zers. There's a lot of slack across the economy, but that's one of the major areas where we're having issues. Moving on to the markets, cryptocurrencies are doing very well. Bitcoin, sort of the king of them all, sort of market cap, was up to about 70,000, up about 100, was it 80, 190 bucks on the day, something like that. The rest of the crypto market looks generally green. Solana at the time of this reporting is down about $6.48. That will change by the end of the day. But overall, cryptos are doing pretty well. It's a nice little recovery in that market over the last few weeks. Also wanted to talk about what's going on in the bond market. Overall, bond rates are still rising, although a little bit fallen off today. Today, the 2-year benchmark is down 0.0015 to 4.822, but it's still a little bit higher than it has been. And the 10-year is at 4.402. Still yield curve inversion, shorter term debt trading at higher than the benchmark 10-year, which is again screaming recession, screaming recession, screaming recession. It's been doing it for a year now. The 1 month is trading up to 5.357. So if you're taking really short-term debt, you'll get good interest rates because of the risk. The 2 month is at 5.384. The 3 month is at 5.389. The 4 month, 5.406. 6 month, 5.372. And 1 year, 5.138. So everything short of the 2 years above 5%. Those are danger zones in terms of having to repay back that debt. And it really limits the options of what the Treasury and Yellen can do in terms of issuing debt and what tranches they issue, short-term, long-term, and their ability to manipulate the yield curve. So that's going to box in some of the policy decisions that U.S. government can make going forward as we're heading into this recession. Another story I wanted to talk about with regards to layoffs is now another big company, Pixar. Pixar, according to CNBC, is laying off 14% of its workforce as Disney scales back content. The bullet points on the CNBC article are: Pixar Animation Studios is laying off about 14% of its workforce, or around 175 employees. The cuts are part of Disney CEO Bob Iger's overarching mandate to focus on quality content, not quantity. Pixar will refocus on theatrical releases and move away from short-term series for Disney. Pixar, going down here, layoffs hit other Disney businesses last year, according to the article, but Pixar's cuts were delayed because of production schedules. Initially, it was expected 20% of the studio's employees would be laid off. When theaters closed during the pandemic, Disney sought to pad the company's fledgling streaming service, Disney Plus, with content, stretching its creative teams thin and sending theatrical movies straight to digital. The decision trained parents to seek out new Disney titles on streaming, not theaters, even when Disney opted to turn its film to the big screen. So Disney, in other words, made a shift and cannibalized its big money producer in the past on screen and theater for its streaming. Which, compounding Disney's woes, many audience members started to feel the company's content had grown overly existential and too concerned with social issues beyond the reach of children. In other words, a little bit of woke, but a lot of political, cultural sort of theming, and gotten away from the more traditional themes and content that Disney had. So I think Disney's suffering a little bit because of that. We'll see how they restructure and do those types of things, and how they change their content if they do, and how Pixar and Disney's properties either grow or don't grow. It could be another company where we start laying off again more. They've laid off some. Do they lay off more? The public's reaction to some of their decisions, not very positive. So they have to regroup and kind of get back on the stream of where or what basically people want to see if it's going to continue to grow. Anyway, lots of pressure in the economy, lots of job layoffs. You're seeing it in the data. Things are trending down. We're going to recession. The indicator's been there for a long time on the bond market. It's been there in a lot of the markets. But if all you do is watch stocks, you have no clue, because the stock market is the last to be affected. All right, we're going to get into the metals now for the rest of the program. I'm going to focus on silver. We're going to go through gold and silver first. And then the last part, I'll focus on silver. I've got a chart with a little bit of graphics and Fibonacci. I'm going to talk about resistance lines. I'm going to talk about what's going on in terms of the commitment of traders, the positioning of contracts, which actually determines spot price, not the local physical trade, as you may think if you're new to this and trying to learn. We're going to talk about that. We're going to talk about how some short paper dumping is not really doing what it needs to do in the market, because people are coming back after that short paper and pricing it up. And typically the short paper comes in bigger tranches than the long pressure, but the long pressure is coming very pronounced, very sharp, we want the price to rise. And the shorts have to dump paper, dump paper, dump paper. And the longs come back and say, no, we want the price. And every time the short paper tries to keep gold and silver price down, it can't do it. In fact, as of time of this recording, around noon Central Time, gold's down about $3 today, but it's trading at 24.22. It's almost up $100 over the last week. Silver is up slightly 8 cents at the time of this reporting, 31.85, and it's up over $3 and about 35 cents in a week. So last week has really been bullish. Now, we're not going to get the commitment of traders report until next week to show why that moved up, but what's going to happen is we're going to see that people came in and put long paper. But anyway, let's get into it. Let's get into the actual graphics. So you can see really, what is going on with gold and silver markets. We're going to start, as we always do, at the CME Group's website. This is for gold. This is gold futures. You can see a little bit of elevated interest. We had a little bit of a weakness at the end of April, beginning of May, and then we're trending up again. A lot of times you'll see this if people are taking a lot of delivery in gold. You'll see some shorting going, which increases the overall interest, or sometimes it's contract rollovers, although that tends to happen towards the back half of the month. In the front, it can happen at any time. Overall, looking at the total data from yesterday, a change of about 11,000 fewer contracts. So overall, on all of the futures contracts periods that we're seeing from May all the way through December of this year, about 11,000 less contracts on there, a little bit less open interest, people withdrawing or closing those positions. Some of it due to EFPs going over to the UK market, hunting for the metal or hunting for higher prices, because in the US, we tend to have a little bit softer prices on the metals due to the nature of the exchange than we do the other ones. And so I don't look at US spot prices really being indicative of the gold and silver prices across the world. If anything, they're weaker or lower than. And a lot of times people are taking contract positions they have here and going somewhere else, or sometimes they're hunting for the actual metal, get delivery in other markets. Overall, healthy volume right now heading into the summer. A lot of times in the summer, you'll see a little bit of slower gold and silver trade, and you'll see a little bit of slower trade in some of the financials markets. People focus on recreation and vacation here in the States, as the markets still work. They're still there. You can still see price swings in all of them. But generally, you have a little bit less concentrated trading as people kind of park funds in their ETFs and mutual funds and 401k accounts into what they think are relatively safe positions, and then they go do other stuff, and then they come back in the fall, and you tend to see an increase. However, given what's going on in the economy, I do think that we could see some pretty wild price swings, particularly in precious metals and interest rates and bonds as well. So we're not going to ignore those just because of the summer. I actually think that could be a higher volatility period because there's going to be less overall trade in some of these markets and potentially leading to some sharper movements depending on the news cycle and what kind of news that we're getting. So we're going to pay attention to that this summer. We can see that dominant contract month right now, based on trade, is actually in August. It's moved from June to August. Now we have 259,000 contracts trading in August, but June is still a strong month. So that's still going to have a pull on the overall spot price. You've got 2 months now vying for the spot price lead and pricing out how that goes. And I'll show that to you on some of the settlements and how there can be slight differences in the price. Essentially, you kind of average that together to get spot price, or you take like an expected value in a way to get the spot price. And that happens as people roll from one contract to another. Because remember, this is a futures market. As we get closer to the dominant market that's trading, it rolls to the next one. And usually that's 2 to 3 months ahead because, again, futures market, you're betting on the future price. Again, not the physical trade going on right now necessarily, though deliveries can affect this market. Deliveries in the current month and weaker months like we've had in May aren't going to affect it as much. They're going to affect it in other markets. And if you've got a lot of buying or selling going to the retail market in the US, it's not necessarily reflected in this trade that you see here on the screen. Just wanted to clarify that for the people trying to figure out how price is determined and why that may not match your experience in the actual physical market here in the US. All right, overall, 2,875 EFPs. Block trades, I wanted to talk about that for a minute. Block trades are essentially where you have a buyer and a seller buying in bulk or agreeing to a bulk trade, okay, of at least one contract or more, and then coming through Clearport or the other interface that you have and saying, we've already agreed to this, clear this for us. We see a fair amount of block trades here, which means people are taking some offline transactions, agreeing to it and putting it out over the exchange. That's increased quite a bit. And they tend to be a little bit more private transactions. So a little bit more private transactions going on. Now they are cleared in the public market at public market prices, but it's a little bit more private negotiating for that metal going on and a little bit more in bulk. And what that tells me is certain parties are coming up and trying to get bulk access to physical, or at least bulk access to a new contract paper, new price at a time. And that signals an interest in physical, but not wanting to go to the public and put in a trade there, but agreeing to it and then putting it out. I think that they're hunting for physical a little bit and also taking specific positions on gold and silver markets at specific prices at specific times. And again, this is reflective of certain players wanting to sort of manage their exposure to the market and potentially get, better access to deliveries. In other words, certain people are becoming more proactive on the market. And instead of just using the market itself, they're finding a partner saying, and they're having to hunt for it. That could be an indication of slightly less liquidity of the registered amounts of metals on the market. It could be that people are getting together and saying, instead of me going and trade on the big market, let's agree to a deal and then put it on the big market. That way we can secure our metals or our contract positions in that way. I expect that's because some of the volatility, but also certain parties are realizing they want more exposure to the metals. And so they're using this method to kind of, at certain times, just block trade big chunks of metals rather than just going to market and doing it this way. We'll see if that continues to spike up just a little bit. It's not high enough where I have really big concerns, or I think anybody's coming in to behind the scenes take a bunch of metal off the market, but it has been a little bit higher trend the last few months. So we'll follow that and see if that becomes some sort of indicator or canary in the coal mine type of deal. I just wanted to point it out early to say I'm watching that and see what's going on. If we look at Friday's data, much higher EFP numbers, people taking a contract, COMEX going over to London, hunting for it. Those have been elevated the last 2 to 3 years. And it's really people, I think, hunting for metal, but playing the price differences in the US. The US is such aggressive shorting market that prices are higher elsewhere. And that's really what the EFPs are doing. Now at close, we had 538,000 transactions on Monday. It was a very heavy close day, a very, very, very heavy close day. And certainly you can see, that in the overall numbers for gold. Going back to Thursday, very high EFP numbers. Now look, we have 2 months and the EFPs for June in this column here are 5,154. And the EFP numbers for August, which is going to become the next dominant contract month in the next few days, we're at 3,000. So you add those together and you get 8,154 here. You add this 5,154 and this 3,000 on those 2 contracts. And on that day, across the 2 contracts, 8,154 EFPs. And that represents 815,000 ounces of gold. Multiply that by 2,430 price, whatever it is. Do that number in your head. There is a lot of demand for physical. That represents physical demand. Millions upon millions of dollars being physically demanded. Millions and millions and millions. People really are wanting the physical, and it's seen in those numbers. All right. The rest of the program is pretty much going to be about silver. Again, we focused last week on gold. If you want to know from a charting perspective where gold's going, go last week, and it'll give you sort of a long-term picture. This week, we're going to do silver. So we're going to go to volume and open interest on silver. A little bit higher trades, a little bit shorting. You're going to see that going on when these bars go up. Typically, it's shorting, not always, but typically it's a typical pattern. You're going to see that. At close on Monday's data, 188,000 contracts. EFPs in silver at 1,700. Now, you multiply that by 5,000 in silver. There's more ounces in a silver contract, and you're getting a ton of silver as well. So even though the overall EFP numbers are down, the amount of silver ounces being sought physically is extremely large in this market. And if you look at block trades, a little bit lower in silver, but again, bigger contract size. So 503 times 5,000. People are wanting very definitive bulk trades of silver on the market, and those tend to be increasing a little bit from previous years. Looking at Friday's data, at close 189,000 contracts. Again, what's the dominant contract month? Right now it's July, and the next one seems to be setting up for September, and then the big daddy at the end of the year. But for both gold and silver, it's going to be December. You kind of see that trade going on, but people are still piling into July because you have almost 8,500 contracts increase on Friday's data. You look at Thursday, 178,000 contracts closed, 2,350 EFPs, 29 block trades. So overall block trade 594 on Friday for the block trade. So overall, a healthy market in silver, a healthy physical access market in silver. One of the things that I want to show you in silver before we get into positioning and the charting is how many deliveries. Now, I did say last week there were about 5,730 physical deliveries in silver in a very thin month. May is a thin month. There's not a lot of contracts. So the actual physical delivery has to be in the current month, not the dominant futures month. And we don't have that many contracts at close. But even from last week to this week, there weren't that many contracts left. A lot of them delivered. We went from 5,700 to over 5,900 on silver. And if you look at silver here, this is silver 5,000 contract, same contract, 5,000 ounce silver futures. These are the yearly totals. This is the current month of May in this column going down, and we're up to 5,978. I said we could approach 6,000, and darn it if we aren't 22 off. And with 200 and some contracts remaining, we could get to 6,000. Now, what I want to point out to you, this is the biggest month even dating back to last December. December in both precious metals tends to be a very heavy delivery month because it's the one month both metals have heavy trading volume. And when you have more contracts, tend to have more deliveries. But 2 months in the year already, the two biggest trading months, which you could have deliveries in 2024 since December, were March and May. And in both cases, it's been increasing. 5,487 contracts down here in March, deliveries, physical deliveries, and now 5,978. We may get to 6,000. So what that says is the overall trend for deliveries, if you look at all the data, you look at the block trades, you look at the EFPs, you look at the actual physical deliveries being reported, is decidedly up in both metals this year as the volatility in the economy increases. It's decidedly up, and I think it's going to continue to get bigger. You just need those big contract months with a lot of trade, open interest, to where you can get a lot of those deliveries. But I think we're going to continue to see a lot of physical delivery. People are looking for the physical metal. That is abundantly clear. And the trend is to beat the previous year's typical big ending month in December and to increase it. So I don't know what's going to happen this December, but I believe we're going to see huge deliveries in both gold and silver on the market this December if that trend continues. And even though that this is a paper traded market where prices are determined, all the amount of physical you could possibly get off of it, people are getting off of it. And I think a lot of it's flowing east. All right, now on to the commitment of traders. This report really discusses the overall aggregate positions of certain types of players in the market. And again, remember, this is a paper market. I just talked about physical, but let's separate that. Some contracts are delivered physical. It's less than 1% on average. In fact, sometimes it's less than 0.1%. Most of the trading is done in paper, thousands of times per day, and that sets the spot price, not the physical. And so what we do is we like to look at that. And this report's always in arrears. This is through May 14th. It's the way the CFTC, the regulator, compiles this report. So it gives us a clue as to what happened in the last week in gold and silver trading. Well, if we want to look at last week in gold and silver trading, it's this right here. These little areas, the last week in trading, you're going to see a key resistance point here. What kept that from breaking through last week, sort of testing this resistance line 3 times and coming back down and then bumping through the end of last week into this week, was the fact that there was more dumping. I'm going to draw that connection here. So if you look at silver, this is the silver portion of the chart, and this is all metals, but I'm just highlighted in blue as the silver part of the table, the silver subtable, if you will. If you look at the overall short positioning from the bullion banks, which are the ones that offer a lot of the speculative short position paper, not the producers and merchants who are actually using the metal, but the banks who are doing the speculative or the betting side of it, they increased their short positions in silver at 34.10. Well, look at what they were trying to do. They were battling this Fibonacci line right there. They lost as silver punched through, but they were trying to battle it 3 times. And finally, the market said, screw that. I don't care how much short paper you're putting through. We're going to push long hard, and we're going to break through. And silver had a breakout through 30, ended the week above 30, and is now trading at over $31, despite all of the shorting. You say, Rob, how do you know that's a point in time shorting? What's the overall short position? Well, look at it. From the swap dealers, from the speculative long and short trading, the biggest concentrated position in short are the swap dealers. I know that from the Office of the Comptroller of Currency report, and this down here, which has said there are 4 traders that have about 1/3 of all shorts and 8 traders that have 46% of shorts. Well, guess what? We do have shorts here in producer merchants, but that's legitimate hedging of their production or their use of silver. This is more the speculative side, and the speculative bullion banks, which I call the swap dealers, same thing, are more than 2 to 1 and trending up in terms of short to long. Means their net position is short. And at one point about 2 months ago, it was dead ass even. It was something like 30 or 40,000. I don't remember the exact number of contracts, dead even long and short. And now they've gone heavy short. And in the last week, 34.10. Well, that 34.10 didn't stop this pop up in silver. So their shorting is not as effective. They're going to have to do more shorting if the purpose was to keep the silver price down. You know, you can see the shorting coming in, defending some of these lines on the chart. So you have to surmise from that they're still protecting the upside price of silver. They don't want it to rise, the bullion banks. Now, who are the bullion banks serving? They have their house accounts, which is their own speculative trading, and then they do it for a lot of other people. It could be that the 4 big banks are doing it. It could be that other sovereigns are coming in, other wealthy individuals, although they can do that here in other reportables. They have their own category. It's not the financial houses. The managed money are going long. The managed money financial houses are going long. 5,300 contracts increase. They're taking the other side of that bullion bank trade. So the question is, who's coming in through the bullion banks? Is it the bullion banks and protecting their own metals positions, you know, throughout the world? Is it a sovereign coming in, shorting it so that they can then take the metal off? Why do we know they're taking the metal off? Because look at the actual delivery numbers. Okay, so that's what's going on. We don't know exactly who's doing it. We don't have that level of transparency, account level transparency, but we know it's being facilitated through the bullion banks, and likely the bullion banks are also participating in their house accounts. So you're definitely seeing that in silver. I wanted to just touch on gold for a second. Same thing in gold. The bullion banks increased their shorts that last week, 95.34, whereas the longs only went up 20.79. So a net of about 7,400-ish, 370-ish, something like that to the short side. And again, everybody else is the opposite. The managed money, the financial houses, the financial brokers are up long on gold and a little bit on silver, but not as much. So it's definitely going through the bullion banks, and that's who's doing the shorting. It's abundantly clear just from the report. Now let's go to the chart, and we'll end up just talking about the chart, and then I'll do the summary for this week. Overall, the long-term trend, this chart is dating back from the 60s to 2022. So we're looking at almost 60 years of data, about 56 years of data. You can see that, you know, once you really got into the early 70s and the commodities markets were formed here in the US in their current iteration, that the price of silver was allowed to kind of free trade. And there's this really big cup and handle pattern dating back 1978 to 22. You'd be looking 44 years. 2011. So that would be, 33-year cup pattern. And then from 2011 to 2024, which would be about 13 years, handle. So is that 30-something years cup, 13 years handle, overall 44 years cup and handle pattern. And cup and handle, and this is not a perfect cup and handle pattern, because this handle, I mean, this is a lopsided cup if your handle's way down here. This is like a cup with a really big handle. So it's not the typical cup and handle pattern, although there are some similarities. Generally, it tends to be bullish on price when you see this, especially over long time frames, especially when you're looking at nominal prices and you're not looking at real prices adjusted for inflation. When you look at silver adjusted for inflation, we're looking at $200 to $300 silver. When you go back to like 79, 80, where silver popped because of inflation. Silver popped because of inflation and problems in the economies. It got to $50. $50 back then, 40 some years ago, is not $50 today. You're looking at about $200 in terms of fiat money debasement, in terms of inflation, not CPI inflation, but real inflation. And so we expect silver's upside to be really, really high. If you go to the top of this trend line, you're looking at $60 silver, but I don't even think it's there. If you look at the breakout pattern out of a cup and handle and out of this long-term chart, I mean, you could easily see hundreds and hundreds of dollars silver. And that's just looking at it from a technical perspective. You look at it from a real perspective in terms of how we're using silver for everything, just about in the economy. It's the most critical mineral in the economy. Like, multiple things just stop if we don't have it. You know, they have to protect that price and keep the silver flowing, but we're running shortages. At some point, that shortages and then the coming monetary demand when we have the next recession is going to drive that cost of silver beyond what people are capable of seeing today, even maybe even capable of charting today, given the charting. But I wanted to look at the price. So if you look at the peak in 2011 and go back to where it started trading on the commodities markets in the 70s, when you had the Commodities Futures Trading, the Commodity Act, and then the Commodity Futures Trading Commission created as a regulator. This is the Fibonacci. So what we see is from the previous high in 2011, when we had the last Great Recession, silver came down and up. And as it came down, it was testing this fourth deviation down, or fourth tranche down, fourth Fibonacci line down from its peak. And it was trading right there, sort of in the middle of this cut pattern, this 30-something year cut pattern. And then it kind of range traded for a long time. And then as we saw COVID in 2020, both gold and silver popped, and it broke out of that little Fibonacci or range trade, if you will. And it stayed up for a while, and then it came back down as the illusion of economic stability loomed, okay? And then as the illusion of economic stability is now falling away in the current situation, people are starting to see what's going on in the economy. It's popped, and they've been defending it. They defended this Fibonacci, and they stopped it from getting to this, to the $30 price. We know the tamp downs and all that kind of stuff. And then it came back down and range traded in this Fibonacci for a while. And then it tested 3 times, and there's a lot of short paper dumped at that point in time. Remember, we were even on short paper, and then you saw the short paper increasing. Why? Because they're defending this price, about $24.50. That was key up until 30. $24.50, $25 silver is key from past history until you get to 30, because as you get past 30, there are less history on the chart of stopping points of gold and silver. Most of the time, silver has been trading down here. So as we break through this 24.50 line and get through 30, this is when you're going to start to see that exponential increase up, because now we're in new territory for silver, where for most of its life, at least in the US modern day markets, it hasn't traded above that. So we're in clear 50-year breakout terms in terms of silver. You say, Rob, it was $50.80, and it was touched on $50 again in 2011. And I'm like, yes, I know. But what we're talking about is a longer term trend in terms of shortages of the physical, in terms of its mineral use and its economic use. And the end of the dollar cycle, which by the way coincided, the pure fiat dollar cycle coincided with the creation of the commodities markets and the ability to control that price of silver using paper. Think 2 paper systems. Fiat paper, pull gold, silver out of the money. So now we got to control the gold and silver markets with what? Contract paper. See, they removed the physical from the fiat money backing, and they removed the physical from the contract so that they could trade them the same. And then they used the US dollar to say, well, this is what the economy is really doing. But now people have figured out that that fiat money is falling away, and that control over here in the derivative market is falling away, and the price keeps going up as a result. So I think we're in a clear 50-year breakout pattern for silver in terms of the ability of the derivative markets to manage it, not necessarily in price, but the price explosion comes after. It's those 2 factors I talked about: the importance of industrial usage and the shortages the last few years, as well as the coming monetary demand because of what's going on in the economy. Silver is the poor man's gold. More people can access silver per ounce and stack ounces. And so people may not be able to afford $2,400 gold, but they can probably afford $30 silver in their budget. It's easier to get an ounce and to get it at a pretty good premium without going to like a fractional. So that's why silver is attractive from a monetary standpoint. Certainly we've had a lot of stackers over the years stacking for the impending, financial blow up or just long-term security. And the story that silver is actually running out physically in shortage because we need so much and we're not producing enough. And the side effect of that price being held down kept the mines from growing and producing more. A lot of those mines are sitting stationary. All those factors are going to come together where silver at some point is just going to go boom. And I don't care what the CFTC or CME Group or anybody does on those markets or how much short paper, the physical is going to separate from the derivative paper pricing scheme. And when exactly that happens, I don't know. But that trend is so abundantly clear that once we see the next big recession and people come into silver from a monetary perspective, the shortage will become more apparent. And then at some point, you're going to have a runaway price of silver. A lot of it depends on how bad that next recession is. I think it's going to be a big one. And so I think we're nearing the end of the derivative price control in the US of silver and gold. And I think those are going to explode upward and set new generational highs, new nominal price highs, and real-time price highs when adjusted for real inflation. That's why the numbers are going to be so big, because of all the hidden inflation. CPI is such a crappy inflation number. So the numbers are going to be so big, and that's coming. And we've been talking about for 15 years now, but it looks like we're in that last sort of stage before it's actually going to happen. Now, the last stage can take a while. All the systems that the US and the rest of the world, they know the system is breaking. They don't necessarily want it to happen right now. Everybody's rushing in. Their response is rebuilding trade, rebuilding central bank digital currencies, rebuilding all these things. And so the world's not quite ready for that to happen yet, but I think we're getting really, really close to it. And as you hear more chatter about central bank digital currencies come on, and digital this and AI, all of this technology that will be used to manage currency in the new system, that's your signal that we're ending the old system. And then you're going to have the breakout in the metals for sure, because they're going to need to revalue gold to support the banking system. It's going to be 40% of the new CBDC system. And you're also going to need silver to be used in markets, and you're going to have real prices to get those new mines up and running, or else you're not going to have the silver to run that technical economy. So they're going to have to let silver price run high enough to run that technical economy. And I think we're at that early stage breaking point in silver where it had to go above 30 to get enough silver mine production on to support that coming digital system. But this is not the big breakout, because the big breakout comes when physical silver disassociates, the prices disassociate from that system as it collapses, and we move into people trying to hoard physical silver as money, which is coming. So hopefully that's a good description of sort of where we are in that overall long-term silver cycle, some charting there for you, some data there for you, relating it to where we are now, and kind of trying to figure out what part of that long-term stage we're in as we work our way to the big breakout. Silver squeeze was the markets 3 years ago, almost 3.5 now, was the early market's reaction to it, the stackers' reaction to it, some of the younger generations coming in and buying some of that paper and SLV. But as people wise up and go for the physical, and as more people get aware of this, the next silver squeeze is going to actually break and obliterate that market, and it's going to actually change the market. Think about technical charting. Sometimes you see blips and they see a big breakout either up or down. Silver squeeze is a little blip. It's a cultural blip onto the big blip of where silver really kind of goes crazy. I think gold will go first, but silver will fall close behind. And because of the dynamics of silver trade versus gold, which are different, silver is going to go up. I still think multiples of what percentages of what the gold price is going to go up. And at some point you could see hundreds and hundreds and hundreds and hundreds of dollars silver. And I think it'll be interesting how long that stays and what that looks like. We're certainly going to be here for it. We're going to continue. Last Thursday, a little bit of business. That was my summary. A little bit of business for this week and what happened last week. Last week, I had a major power outage in Texas due to storms. Couldn't get the video out on Thursday. Chose to hold it for this week and chose to postpone one of my interviews as well. I had to postpone one of my interviews. So we only had that one piece of video content last week. This week, we're going to have two. Thursday, I'm going to go back into digital control systems, CBDCs, that kind of thing. And for next week, I'm trying to get a good interview scheduled for the Freedom Report, getting a little bit more into cultural things, cultural mechanisms, politics, the political economy when we're in this sort of breaking economic system, and kind of explore that more for you guys at the Freedom Report. So stay tuned for that. We're going to build that out, and we got plenty of time over the summer leading up to the election cycle to really talk about some of the cultural and political aspects of what's going on in full breadth. And I think it's going to get more exciting as we head into this next political cycle as well, because there's a lot at stake there. And that's why we're kind of expanding program content this time. It's the time to do it. 2024 is the year of volatility. And it's not just going to be in economic markets. It's going to be across the board everywhere, all around us, and not only in the US, but around the world.
And it's time to kind of examine that and see where we may be going with that. All right, this is going to do it for the weekly market report. Thanks, guys, for joining in. Stay tuned for Thursday's video. Till next time, Rob Kientz with the Freedom Report.